The number one reason physical silver is in serious trouble right now. Stop. Right now, before you scroll, before you click away, I need you to hear one sentence. The physical silver market has approximately 90 days before something breaks that cannot be fixed. Not the paper price, not the futures market, not the manipulation game they've been playing for decades. I'm talking about the actual physical metal, the bars sitting in vaults, the coins dealers are trying to ship, the supply chain that connects mines to refineries to warehouses to your hands. That system, the one that actually matters, is on the verge of catastrophic failure. And when it fails, it won't matter what the COMEX price says. It won't matter what Bloomberg reports. It won't matter what your favorite analyst predicted, because you won't be able to get physical silver at any price. Ladies and gentlemen, Asianguy here. And I'm about to tell you something that goes against everything you've been hearing in the precious metals community. Something that most silver YouTubers won't say because it's too uncomfortable, too alarming, too far outside the narrative everyone wants to believe. The biggest threat to silver investors right now is not manipulation. It's not paper markets. It's not government intervention. The biggest threat is that the physical supply chain is collapsing in real time, and almost nobody is paying attention. By the end of this video, you will understand exactly what's happening, why it's accelerating, and what it means for every single ounce you own or are planning to buy. This is not fear porn. This is not clickbait. This is a structural analysis of a market in the final stages of breaking down. Let's get into it. The supply chain nobody talks about. Most people think about silver in simple terms. Miners dig it out of the ground. Refineries process it. Dealers sell it. You buy it. Simple, right? Wrong. The physical silver supply chain is one of the most complex, fragile, and time-sensitive logistics operations in the entire commodity world, and almost nobody understands how it actually works. Let me walk you through it, because understanding this is the key to understanding why everything is about to break. Step 1. Primary production. Silver comes from two sources. About 25% comes from primary silver mines, mines where silver is the main product being extracted. About 75% comes as a byproduct of other mining operations, mainly copper, zinc, and lead mines. This is critical to understand. Most of the world's silver supply is not produced because someone wants to mine silver. It's produced as a side effect of mining other metals. What happens when copper prices crash? When zinc demand falls? When lead mining slows down? Silver production falls with it. Even if silver prices are high, even if demand is strong, you cannot simply mine more silver when the price goes up, because most silver isn't being mined for silver. Step 2. Refining bottleneck. Once raw ore is extracted, it must be refined into pure silver. There are approximately 30 major silver refineries in the world capable of producing London Good Delivery bars, the international standard that major vaults and institutions require. These refineries operate at near maximum capacity during normal times. Right now, they are overwhelmed. Lead times for refining services have gone from 4 to 6 weeks to 16 to 20 weeks in some cases. Refineries are turning away new business. They physically cannot process the volume of material being delivered. Why? Because of what happened in January 2026. When silver spiked to $121, every mining company on Earth that had been stockpiling unrefined silver concentrate suddenly rushed to get it refined and sold. When silver crashed back to $64, industrial buyers who had been hesitating suddenly rushed to lock in supply. The refineries got hit from both sides simultaneously, and they don't have the capacity to handle it. Step 3. Vault logistics. Once silver is refined into bars, it must be transported to vaults. This is not as simple as loading a truck. A single good delivery silver bar weighs approximately 32 kilograms, 70 pounds. A standard pallet holds about 40 bars. That's 1,280 kilograms, nearly 1.3 metric tons of metal per pallet. Moving this requires specialized armored transport, insurance coverage, expensive and increasingly hard to obtain, secure vault facilities with available space, customs clearance for cross-border movements, documentation and chain of custody tracking. Every one of these steps is experiencing stress right now. Step 4. Last mile delivery. Finally, silver must get from wholesale warehouses to retail dealers to you. This is where the system is breaking most visibly. Dealers are experiencing 8 to 12-week delivery delays on products that used to ship in 3 to 5 days, shortages of specific products, even when silver is theoretically available, inability to get smaller denominations, 1-ounce rounds, fractional silver, even when 100-ounce bars are available, canceled orders when suppliers can't actually deliver what was sold. The number one problem, the fabrication collapse. Now we get to the core issue. The number one reason physical silver is in serious trouble, and it's not what you think. It's not manipulation. It's not vault draining. It's not even the supply deficit. The number one problem is that the fabrication industry, the companies that turn refined silver into the products you actually want to buy, is collapsing. Let me explain. When you buy a silver eagle, a maple leaf, a generic round, a 10-ounce bar, that product doesn't come straight from a refinery. It comes from a fabricator, a mint, a company that takes refined .999 silver and stamps it into coins, pours it into bars, creates the products that retail investors actually purchase. And these companies are going bankrupt. The fabricator death spiral. Here's what's happening. Fabricators operate on thin margins. They buy refined silver, add their manufacturing costs and overhead, and sell finished products to dealers at a small markup. In a stable market, this works fine. But in January 2026, when silver went from $30 to $121 in weeks, fabricators got destroyed. Here's why. When fabricators buy refined silver, there's a time lag before they can manufacture and sell the finished product. Let's say a fabricator bought silver at $80, intending to manufacture 1-ounce rounds. The manufacturing process takes 2 to 3 weeks by the time you factor in taking delivery of the refined silver, manufacturing the rounds, quality control, packaging, shipping to dealers. By the time their product hits the market, silver has crashed to $64. They paid $80. The market price is now $64. They're selling products at a $16 loss per ounce. Multiply that by hundreds of thousands of ounces, and you're looking at catastrophic losses. This happened to dozens of fabricators in January and February 2026. Some have declared bankruptcy. Others have stopped production entirely. Several have been acquired by larger competitors at distressed prices. And here's the crisis. The ones that survived are now terrified to carry inventory. They're only manufacturing on a made-to-order basis with significant delays. They're requiring full payment up front before starting production. They're minimizing their exposure to price volatility. The result? Massive shortages of retail silver products even when wholesale refined silver is technically available. The mint crisis. It's not just private fabricators. Even sovereign mints are struggling. We covered in a previous video how the US Mint suspended sales and then raised prices 86% overnight when they came back online. But it's worse than we discussed. The US Mint is legally required to produce enough silver eagles to meet public demand. That's the law. But they physically cannot do it right now. Why? Because they depend on silver blanks, pre-formed discs of silver, from a small number of approved suppliers. Those suppliers are the fabricators we just discussed, and many of them are out of business or operating at reduced capacity. The Perth Mint suspended kangaroo coin sales not because they don't have silver, but because they can't get their products through quality control fast enough to meet demand. The Royal Canadian Mint is running 16-week delays on maple leafs. These are government institutions with unlimited access to capital and refined silver, and they still can't keep up. The premium explosion. The fabrication crisis is why premiums have exploded to levels that make no economic sense. Right now, you can buy a 1,000-ounce good delivery bar for approximately $75,000, assuming $75 an ounce spot price. But if you want that same silver in the form of 1-ounce coins, you're looking at Silver Eagles, $95 to $110 per coin, equals $95,000 to $110,000 for 1,000 coins. Maple Leafs, $85 to $95 per coin, equals $85,000 to $95,000 for 1,000 coins. Generic rounds, $80 to $88 per coin, equals $80,000 to $88,000 for 1,000 coins. You're paying a $10,000 to $35,000 premium to own the exact same amount of silver in a different form. Why? Because the ability to transform refined silver into retail products has become the bottleneck. The refined silver exists. The fabrication capacity does not. The secondary market breakdown. Now let's talk about what this means for the secondary market, because this is where things get really scary for stackers. Normally, when retail premiums get too high, the secondary market provides relief. People who bought silver years ago at lower premiums sell into the market. Pawn shops release inventory. Estate sales provide supply. This secondary supply typically accounts for 15 to 20% of retail silver availability in normal markets. But right now, that secondary supply is evaporating. Why would someone sell their silver eagles for $95 to a dealer who will pay them $70 to $75 when they could just hold them knowing that premiums are rising? Smart secondary holders are waiting. They're watching premiums climb and realizing that if they hold another few months, they might get $100, $110, $120. So secondary supply is drying up exactly when the market needs it most. The dealer collapse. Which brings us to the dealer crisis. Small and medium-sized precious metals dealers are going out of business at an accelerating rate. Why? 1. Margin compression. When spot price is volatile, dealers can't maintain stable spreads. They get caught holding inventory that's suddenly worth less than they paid. 2. Cash flow crisis. When fabricators demand full payment upfront and delivery times stretch to 12 to 16 weeks, dealers must tie up massive capital for months with no revenue. 3. Bank de-risking. As we discussed in a previous video, major banks are exiting relationships with precious metals dealers. When dealers can't maintain banking relationships, they can't process credit card payments, can't get commercial loans, can't operate modern businesses. 4. Regulatory costs. Enhanced KYC requirements, tax reporting obligations, and compliance infrastructure are expensive. Small dealers can't afford it. The result? Market consolidation. The number of places where ordinary people can buy physical silver is shrinking rapidly. 5 years ago, there might have been 200 online dealers in the US offering competitive pricing. Today, maybe 50 are still operating normally. A year from now, maybe 20. The 90-day timeline. Now let me explain why I said you have approximately 90 days before something breaks that cannot be fixed. Here's the convergence of factors happening simultaneously. March-April 2026, refinery capacity crisis. Refineries are already running 16 to 20-week backlogs. If another price spike occurs and mining companies rush more concentrate for refining, those backlogs extend to 24 to 30 weeks. At that point, the lag between mine production and available refined silver becomes so long that the spot price and the physical price completely decouple. April-May 2026, fabricator consolidation. The fabricators that survived the January crash are barely hanging on. Another round of volatility and several more will declare bankruptcy. When the number of operating fabricators falls below a critical threshold, even the survivors can't handle the volume. Manufacturing capacity becomes the ultimate bottleneck. May-June 2026. Dealer inventory depletion. Dealers who are still operating are running down inventory because they can't get replacement stock. Once inventory is sold, they have nothing to offer customers for 12 to 16 weeks. At that point, the retail silver market effectively freezes. You can buy silver, but you won't receive it for months. And there's no guarantee the dealer will still be in business when your delivery date arrives. The perfect storm. When these three crises converge, refining backlog, fabrication collapse, dealer inventory depletion, you get a perfect storm. Physical silver becomes functionally unavailable at the paper price. You can see a price of $75 on your screen. But you cannot buy physical silver for $75. You cannot buy it for $85. You might not be able to buy it at all, at any price, in the form you want. The COMEX price becomes an abstract number representing a synthetic asset that has lost connection to physical reality. And this is when governments step in. The government response. When essential commodities become unavailable to the public due to supply chain breakdown, governments intervene. They don't confiscate. That's politically difficult. Instead, they implement 1. Rationing, purchase limits, annual caps, allocation systems that prioritize essential industrial users over retail investors. 2. Licensing. Requirements that buyers obtain permits or licenses to purchase precious metals above certain amounts. 3. Approved dealers only. Restrictions that only allow purchases through government-approved dealers who maintain expensive compliance infrastructure. 4. Price controls. In extreme cases, regulations that set maximum retail premiums above spot price to, quote, protect consumers from gouging. All of these make physical silver legally available, but practically inaccessible for ordinary people. And they happen not because of malice, but because of crisis. When people are rioting because they can't get products they want, when dealers are going bankrupt, when the supply chain is in chaos, governments feel pressure to, quote, do something. And what they do always involves more control, more restrictions, more barriers to entry. What this means for you. If you're holding physical silver right now, here's what you need to understand. You are on the right side of the trade. The people who will be destroyed by this crisis are the ones holding paper promises when the physical supply chain breaks down. But you need to be strategic about several things. 1. Product diversification. Don't only hold one form of silver. Have some. Government coins, eagles, maples for maximum liquidity. Generic rounds for lower premiums. 10 ounces and 100-ounce bars for larger denomination needs. Junk silver, pre-1965 US coins for small transactions. When certain products become unavailable, you want flexibility. 2. Establish dealer relationships. If there's a dealer you trust who's still operating normally, make purchases now to establish yourself as a customer. When allocations and rationing begin, dealers prioritize existing customers over new ones. 3. Realistic premiums. Accept that premiums are not coming down. The fabrication crisis is structural, not temporary. If you're waiting for premiums to return to normal levels before buying, you may wait forever. 4. Private storage supremacy. Do not rely on unallocated pool accounts or ETFs for your precious metals exposure. When the supply chain breaks down, allocated, private storage, and physical in your possession are the only forms of ownership that give you actual control. 5. Small dealer risk. Be cautious about prepaying small dealers for products with long delivery times. The bankruptcy risk is real. If a dealer goes under before delivering your order, you're an unsecured creditor fighting for pennies on the dollar in bankruptcy court. The uncomfortable reality. Here's the part that's going to make stackers uncomfortable. The supply chain crisis is good for you if you already hold physical. When fabrication capacity is the bottleneck, the value of already fabricated retail silver products increases dramatically. Your silver eagles bought at $30 with a $5 premium aren't just worth spot price. They're worth spot plus whatever premium people are willing to pay to get silver in that form. If premiums go to 50%, 70%, 100% over spot because fabrication capacity has collapsed, your existing stack is worth far more than the paper price suggests. But this only applies if you already own physical. If you're waiting on the sidelines, planning to buy when quote-unquote the time is right, you may discover that the time is right when you can no longer get physical at any premium. The contrarian take. Now let me give you the contrarian argument, because intellectual honesty requires considering the opposite case. Maybe the supply chain stabilizes. Maybe new fabricators emerge to replace the ones that went bankrupt. Maybe refineries expand capacity in response to higher fees. Maybe sovereign mints get their act together and ramp up production. Maybe secondary supply floods the market when stackers see high premiums and decide to sell. Maybe the dealer consolidation creates more efficient operations that can serve the market better. Maybe technological improvements in fabrication reduce costs and increase speed. All of this is possible. Markets have a way of finding solutions to supply problems when prices are high enough to incentivize investment in new capacity. But here's the key point. Building new capacity takes time. A new refinery takes 3 to 5 years to build and permit. A new fabrication facility takes 12 to 24 months minimum. Training new workers, establishing dealer networks, building trust, all of this takes time. So even in the optimistic case where the market eventually solves the fabrication crisis, there's a gap. A period where demand exceeds supply, where prices spike, where availability is constrained. And that gap is the next 90 days to 6 months. The final warning. Physical silver is in serious trouble, not because of manipulation, not because of paper markets, not because of anything the bulls or bears are arguing about, because the supply chain that delivers physical metal to your hands is collapsing under the weight of volatility, thin margins, regulatory pressure, and capital constraints. The refineries are overwhelmed, the fabricators are going bankrupt, the dealers are closing, the mints can't keep up. And when this convergence reaches critical mass, which I estimate is 90 days or less, physical silver will be functionally unavailable at anything close to the paper price. You'll see $75 on your screen and pay $110 for a coin if you can find one at all. That's not a prediction. That's a logical outcome of the structural forces already in motion. If you've been stacking, you're positioned correctly. Hold your metal. Don't let volatility shake you out. If you've been waiting to buy, your window is closing fast. Not because price is running away, because availability is running out. And if you're holding paper silver, ETFs, unallocated accounts, promises, understand that when the physical supply chain breaks, your paper may not convert to metal the way you think it will. The crisis is not coming. The crisis is here. Drop a comment and tell me, are you seeing supply chain issues in your area? Longer dealer delays? Products unavailable? I want to hear what you're experiencing on the ground. This is Asianguy, where the biggest threats are always the ones nobody's watching.